One reason for the stock market decline on Monday was the 12.4% plunge in the Japanese stock market that occurred earlier in the day. That stock market recovered most of its losses on Tuesday, August 6th, rising 10.23%. Japan's central bank hiked its benchmark rate to 0.25% from 0 to 0.1% on July 31st, 2024, as the yen hit a 30-year low against the US dollar last month. The profits of Japanese manufacturers increased in response to the weakening yen as Japanese products become less expensive for purchasers using a stronger currency to buy them, like the US dollar. Then on August 5th, the Bank of Japan released the minutes of its June meeting that summarized concerns about inflation uh, being caused by the weakening yen, and that may have precipitated the panic in Japan's stock market that carried over into the U.S. Later that day. The rise in Japan's market earlier today indicates that investors realized that the plunge on Monday was an overreaction to the insignificant increase in the benchmark rate to 0.25%. A related matter that would impact the U.S. stock market is the carry trade, where investors borrow money in yen, convert the yen into a foreign currency that is stronger in value and has assets that can be purchased with much higher yields, like a U.S. government 10-year treasury, or used to buy stocks that have been showing robust gains, like the Magnificent Seven in the U.S. The investor benefits by having the stronger currency continuing to increase in value against the yen. The higher yield earned on assets priced in the foreign currency, like the US dollar, or more robust stock gain, purchasing more robust stock gainers through funds borrowed in yen, like NVIDIA, as an example. In response to the interest rate hike by the Bank of Japan, the yen rose quickly and significantly in value against the dollar, possibly leading to a partial unwinding of carry trades where the asset is sold with proceeds converted from the foreign currency back into yen in order to repay the loan. Some of that may also be due to the decline in value and the robust stock gainers in the U.S. Stock market that occurred starting last month. Another issue on Monday was Berkshire Hathaway releasing its quarterly report over the weekend, which indicated that the company had sold almost one half of its very large stake in Apple. Berkshire's cash and treasury bill position increased from $163.291 billion as of 12/31/2023 to $271.602 billion as of 6/30/2024. In July 2024, the Form 4s filed by Berkshire with the SEC showed a rapid and significant reduction in Berkshire's position in Bank of America stock, which is another major position. So that would have increased the cash and treasury bill position by about $3.8 billion if none of the funds had been redirected back into other stock purchases. The last Form 4 on the Bank of America sales included only transactions from 7/31 to August 1st. So the Treasury bill position was increased by Berkshire, even though Buffett knows that the yields are already going down in anticipation of Fed rate cuts. The most important reason for the U.S. stock market decline was the July employment report released last week, which I discussed in my last blog post. All of the data pointed to a weakening in the labor market, which included a rise in the unemployment rate to 4.3%, the 0.1 hour decline in the average work week, which doesn't sound like much, but becomes significant when applied to the total workforce earning less per week. The slowdown in wage growth and the lower than expected job growth number of 114,000, down from a revised 179,000 in June. That 179,000 number in June was revised down from 206,000 when the BLS released its July report in early August.